banks finally gave you a win, right? 5% interest just for letting your money sit there. It feels like the smartest move you've ever made until you actually do the math. Welcome back to the FinRadius USA. Today, we are deconstructing the high-yield trap. I'm going to show you why a 5% savings account is actually a mathematical sedative designed to keep you from moving your capital into assets that actually grow. In 2026, if you aren't calculating for the invisible tax and the real rate of inflation, you are losing wealth while you sleep. By the end of this video, I'll show you the math of loss behind your savings account and the 3-step strategy to actually protect your purchasing power. Let's look at the numbers. If you want to protect your labor value and insulate your family's future, subscribe right now and hit the notification bell. For over a decade following the 2008 financial crash, banks paid near 0% on cash deposits. Savers felt completely ignored while central banks printed trillions and inflated financial assets. So when high-yield savings accounts suddenly surged to 4 and 5%, depositors celebrated like they had won the lottery. Depositors put $100,000 into an online account and saw $5,000 in interest arrive annually. It created the dangerous psychological illusion of risk-free passive income. Here on the FinRadius USA, we call this the nominal yield mirage. Your brain registers the nominal increase in digits while completely ignoring the real purchasing power destruction underneath. Let's dismantle the first hidden deduction, the ordinary income tax trap. Unlike long-term investments that enjoy preferential capital gains tax rates, bank interest is taxed as ordinary income. If you are in a moderate 24% federal tax bracket and pay 5% state tax, your total marginal tax rate on that interest income is nearly 30%. That $5,000 interest payment is instantly slashed by $1,500 in taxes. Your actual after-tax return on that 5% account is barely 3.5%. You took all the counterparty risk of holding cash, and the government took nearly a third of the return before you could spend a dime. But the tax bite is only the minor half of the problem. Deduction 2. The real-world cost of living expansion. Financial media reports headline CPI inflation at around 3%, using hedonic adjustments to smooth numbers downward. But the non-discretionary basket of survival goods, energy, car insurance, food, and housing, expands at 5 to 7% annually. If your living expenses are expanding at 5.5% and your after-tax yield is 3.5%, your safe savings account is delivering a net LOS as of roughly 2% in purchasing power every single year. You are literally paying $2,000 a year in lost purchasing capability for the privilege of parking cash at a bank. Let's calculate the brutal math of loss on $100,000 parked in a 5% HYSA over 5 years. In year 1, you start with $100,000 and earn $5,000 in nominal interest. You pay $1,450 in income taxes, leaving you with $103,550. Meanwhile, real cost of living increases by 5.5%, requiring $105,500 to buy what $100,000 bought a year ago. In year 1 alone, your real net purchasing power drops by $1,950. By year 3, your nominal balance says $111,000, but your real purchasing power has shrunk to $94,000. By year 5, your real purchasing power has collapsed to less than $90,000. You lost over $10,000 of accumulated labor value while congratulating yourself on earning 5%. This is why we call high-yield savings a mathematical sedative. It gives you just enough nominal interest to keep you calm, passive, and compliant while inflation silently extracts your capital. Now, why are commercial banks so eager to offer you 5% interest in 2026? Because the bank takes your deposit at 5% and immediately deploys it into commercial loans or credit cards yielding 9 to 22%. Or they use your deposit as reserve collateral to purchase high-yielding corporate debt and government paper. The bank captures the massive net interest margin while you absorb all the currency debasement decay. They need your capital locked in their accounts to maintain their regulatory liquidity ratios. By paying you 5%, they ensure you won't pull your money out to buy real productive assets. And that does not even factor in the catastrophic opportunity cost of holding cash during market expansion cycles. While your cash lost 2% in real purchasing power, productive assets expanded aggressively. Broad market equity indexes compound at an historical average of 10% annually. Physical gold has appreciated at double-digit rates as central banks hoard reserves. Digital scarcity via Bitcoin has expanded exponentially as network adoption scales globally. By sitting in cash to capture a safe 5%, you missed double-digit asset appreciation across the board. If you are gaining actionable clarity from this quantitative analysis on the FinRadius USA, take a moment to subscribe, like this video, and hit the notification bell so you never miss an archive breakdown. Leave a comment below with your current cash allocation percentage. We read and analyze every single response. Now, let's reveal the exact 3-step strategy to break the high-yield trap and build true sovereign purchasing power in 2026. Step 1. Cap your liquid cash at a strict 90-day operational runway. Calculate your exact monthly baseline living expenses: housing, food, insurance, debt service, and utilities. Multiply that number by 3 to 6 months maximum, and keep that specific amount in your high-yield account or short-duration treasury bills. This serves as your operational friction cushion to handle emergencies without touching long-term assets. Every single dollar above your 90-day operational runway must be evacuated from cash immediately. Holding cash beyond your operational cushion is not security. It is a guaranteed 2% annual tax on your labor. Step 2. Deploy surplus capital into the 4 hard asset pillars. Pillar 1. Broad market equity ownership via low-cost total market index funds. Corporate equities possess pricing power, passing inflation directly to consumers while capturing global revenue growth. Equities also enjoy long-term capital gains, tax rates, and tax-deferred compounding, eliminating the annual income tax trap. Pillar 2. Physical monetary gold bullion stored in private non-custodial custody. Physical gold carries zero counterparty risk, zero annual income tax drag until sold, and has preserved purchasing power across 5 millennia. Pillar 3. Digital scarcity via Bitcoin and decentralized self-custody protocols. Bitcoin provides an uncensorable, mathematically capped protocol with an absolute hard limit of 21 million units. Self-custody on hardware storage keys guarantees direct asset ownership independent of commercial banking clearance channels. Pillar 4. Critical commodities, energy infrastructure, and productive real estate. Tangible real assets represent physical necessities that reprice immediately during monetary expansion cycles. Julian structures his portfolio across all 4 pillars, turning depreciating cash into an undebasable wealth engine. Step 3. Automate your capital allocation and harvest tax efficiency. Configure your primary banking node to automatically transfer 50% of your monthly surplus into hard assets within 24 hours of deposit. Maximize tax-advantaged accounts like Roth IRAs, HSAs, and 401k matches to shield compounding gains from annual ordinary income tax. Automation deletes psychological hesitation and enforces dollar-cost averaging discipline systematically every single month. Dr. Evelyn Vance backtests the purchasing power of an active allocator versus a high-yield cash saver over a decade. The data reveals that the hard asset allocator outperforms the cash saver by more than 180% in real purchasing power. Breaking the high-yield trap requires a fundamental shift, understanding the difference between price digits and real purchasing power. Stop celebrating the nominal interest deposit that hits your bank account every 30 days. Start measuring your net worth by how many ounces of gold, shares of productive equity, or units of scarce assets you command. Paper dollars are transient transaction tokens designed for speed of circulation, not generational preservation. Hard assets are permanent anchors that preserve your labor value across shifting central bank policies. As central banks expand the fiat money supply, hard asset valuations scale upward automatically. You convert currency debasement into automatic capital appreciation for your family's balance sheet. Meanwhile, passive cash holders continue to absorb the silent decay of the mathematical sedative. Julian finishes configuring his automated 4-pillar hard asset allocation system in location_B. His accumulated labor value is now completely insulated against the high-yield trap. Here is the final execution checklist from the research team at the FinRadius USA. Checkpoint 1. Calculate your real after-tax yield and subtract actual household expense inflation. Checkpoint 2. Cap cash at a 90-day operational runway and evacuate all surplus capital into hard assets. Checkpoint 3. Automate monthly allocations into equities, gold, digital scarcity, and commodities every 30 days. Subscribe to the FinRadius USA to join our community of sovereign allocators taking back control. Math deletes institutional dependency. Stay disciplined, stay insulated, and we will see you in the next decoding breakdown.